A lifetime mortgage is a mortgage for people aged 55 plus. It's secured against your home. It's available either as just a single straightforward lump sum or as an initial lump sum with a drawdown facility in the background. So the initial lump sum is exactly what it sounds like. It's a set amount of money that you agree with the lender from the outset. The rate of interest is fixed on that for the rest of the life of the loan. You can choose to pay the interest or let it roll up onto the loan. Just be aware that if you let it roll up onto the loan, the interest will compound, so in real terms you will end up paying interest on interest, and it could increase the balance of your loan over time. When you're talking to your advisor about a lifetime mortgage, talk about the possibility of making interest payments. Even if you can't afford to service all the interest, making an affordable payment towards it can stop that roll-up of interest being quite so bad over time. Any advisor will give you an illustration once they've understood your circumstances, and the illustration will show you the impact of compound interest over the life of the mortgage so that you can have all the facts in front of you before you make a decision. The other type of lifetime mortgage is the one that's based on a drawdown facility. So with this facility, you take an initial lump sum of money and then you have a pre-agreed amount of money in reserve with the lender. Now this pre-agreed sum of money can be drawn on at any time. You simply phone up the lender, ask for however much extra you need, and they will advise you of the rate of that interest, because it may be at a different rate to your initial lump sum. And then if you choose to accept that, then the money will be in your account in a few days or a couple of weeks at most. The real benefit of the drawdown facility is that you can choose when to take the money. So you can choose to take the money when the interest rates are lower. And the other main point is that you don't pay any interest on the funds that are held by the lender until you draw them down. So while they're still in the drawdown facility and not in your bank, then you won't be paying any interest on that, which can save you thousands over the term of your lifetime mortgage, if your circumstances suit that way of working. As with all of these things, it's really important to talk things through with a financial advisor. Look for someone who is qualified to talk to you about equity release, but also qualified to talk to you about products from across the rest of the market, because equity release is a great product. A lifetime mortgage is a great product. They've become an awful lot safer over the years. With more lenders coming into the market, the products have improved massively since I started advising in this area. But they're not for everyone. Your circumstances are unique to you. Make sure you talk to someone who can talk about all of the products available to you so that you can make a really good informed choice about which one suits you best.